All right, everyone, welcome to our September instance of these monthly investor meetings. Today, we'll be featuring Ethan Blum, our Director of Capital Markets, talking about our current state of capital and debt markets. There have been so many headlines lately, so we're really excited to bring Ethan's expertise to you here today. For those of you watching this after and not in real time, hopefully you also are recorded for the rest of the series, bringing us through the rest of this year. Next month, we'll feature Sergio and our COO, Mike Bylarjan, giving a Q3 overview. So especially for those of you who are active investors, that'll be a great one to join live if you can, so you can ask any and all questions, and otherwise certainly catch the replay to get an advanced look at how your investments are performing before our full newsletters and quarterly reports go out on your active investments. For those of you who are still getting to know us and not yet an investor, it's your chance to be a fly on the wall and really get a glimpse behind the scenes and see how everything is going. So we really pride ourselves here at Hearthfire with delivering absolute transparency on all of the operations and how investments are performing. So look forward to seeing you next month as well. Without further ado, let me turn things over to Ethan.
Hello, everybody. How are you?
Good.
Great. Glad everybody joining here. I'm Ethan Blum. I'm our Director of Capital Markets for Hearthfire Holdings. Welcome to our monthly investor series, and this is capital markets focused. And I'm going to try to make this a little light at times and fun and interactive. If anybody has a question or a comment, feel free to drop it in the chat. But I'm very excited to be joined by all of you and to share some updates and some intel and some visibility into the wild world of capital markets, which can be dense at times. But Corinne just mentioned something that I think is worth really kind of reinforcing, which is transparency, and that we really do look at our investors as our partners. Even if you have $50,000 with us, we will treat you and give you as much time, consideration, respect, information as a $5 million joint venture partner of ours. And so some of this is going to be just an education, and you may ask yourself, how does this impact me specifically, which we could of course sort of correlate it to, but bear with me as we go here, and we're gonna have some fun. And this is a great time for this meeting, really, because capital markets is very much in the spotlight in this economy, and very crucial to commercial real estate overall. You've heard of, you see the headlines, rates going up. You may have even heard the term negative leverage. We can get into that later. And so you're wondering, like, what are capital markets and how does this impact me? And so I'm going to start with just sort of a little intro of, like, what is capital markets, right? And capital, just think of, that's money, that's dollars. And the market is just like any other market, any other good or service that you would, buy, sell, or trade. And so the market for that is like any other dynamic market in this country. I'll here's a little example, right? Like, whether you're buying a car, or whether you're buying a loaf of bread, right? There's lots of different options, and there are sellers that control the pricing. Right. So if you went into the supermarket and you saw that a bread company was selling a loaf for $50, would you buy it? Right? Probably not. And that's because there's competition and because there's supply and demand, and that affects pricing of things, right? And you ultimately get to an equilibrium. You say, all right, well, a loaf of bread, I think it's worth $4, or the quality of this, maybe I'll get a higher quality one, it's $5. It's that capital markets is basically that. Right? When you go out and you go and buy a home and you get a mortgage, right? You might call your local bank and they might say, sure, I'll give you a mortgage. It's 20%. And you might laugh and hang up the phone because the bank across the street is offering a 6% mortgage. Well, the bank that's offering the 20%, they're not going to be doing a lot of loans, and they're going to have to bring that rate down if they really want to do deals. And that's in essence what the capital markets for commercial real estate are. We need money to develop or buy projects, and how do we get it, and how is it priced, right? And how is their competition competing for our business? And so Debt, right? A general capital stack is you've got debt and you've got equity. And debt is just a loan, and more and equity is your cash investment. And those are both ways to invest in commercial real estate. You can invest through the equity side, you can invest through the debt side. And so in commercial real estate, capital markets is oftentimes sort of the last piece of the puzzle, meaning when you develop a building, when you buy a building, and this goes for all the largest companies in the country, you have a lot of work and time and money that you spend to get to the point of buying a deal, putting it under contract, or getting your construction budget and timeline in order. And oftentimes the capital markets is actually that last piece. As you're going through your due diligence process, you are concurrently out in the market looking for capital, hence the term capital markets. And oftentimes that comes together in that final kind of month or two before closing. Okay, deep breath. Here we go. Capital markets are in the spotlight. And the reason for that right now is because of where interest rates are. When interest rates are low, and we're going to get into what low means and an historical perspective of that. But there's this term negative leverage, which is when the yield for a property that you're buying is below your borrowing costs. So what does that mean? If you're getting a mortgage for 3% and you're buying an investment property that's paying 6% of yield, that makes a lot of sense, right? You're borrowing money at one cost, you're making a higher rate of return, you're paying back the dollars that you borrowed, and then you're making that difference with no dollars invested of your own. Right? If you borrow a dollar from a bank at 3% and you use that dollar and you make 6% on it, right? You've made 6 cents, you pay back the dollar, you pay back the 3 cents, and now you have 3 cents of profit in your pocket. But you used the bank's dollar to get that. You didn't use your own money to get that. You used the bank's dollar. That's what leverage is. And so you may hear in this economy right now and in the real estate market, the term negative leverage, which is as rates continue to creep up 6, 7, 8%, if your yield is below that, then you're doing the opposite of what I just described, right? So how do we make sense of that all? And how does that and why would anybody take on negative leverage? And that's why we're in the spotlight. That's why there's so much chatter about rates and how that impacts the commercial real estate transactional community and therefore our economy, because commercial real estate is a multi-trillion-dollar enormous percentage of the GDP in the economy. I'm just going to hit on some of these bullet points here. This is sort of just the state of the world a little bit. Construction is still out of favor for many commercial banks that remain in the lending market. We've seen what happened with SVB and other banks. A lot of banks are sort of taking pause, playing a little bit more defense on their existing loan book and not so active in making new loans. The ones that are, they're being pretty conservative, especially in the construction market. Construction loans have much more risk than a traditional stabilized cash flowing property for a variety of reasons. The credit and underwriting standards have tightened. What does that mean? That means when you go to apply for your loan, and I'm going to make some comparisons here to residential mortgages because I think that this is a really easy kind of tangible way to think it, right? When you in 2006, if you went to your local bank and said, I want to buy a house, they might give you 100% financing with minimal sort of, you might run your credit report and look at your pay stubs, but sort of not really go through it with a fine-tooth comb. And we're in a totally different spot right now where lenders are lowering the loan to value. And remember that might be an answer for a quiz later in this presentation. The less that a lender lends versus the value of the property, the more conservative it is for that lender, right? There's more equity at risk and more of a buffer before they can ever lose money. And credit underwriting is really looking at borrowers and looking at what's their credit worthiness and how likely are they to pay me back. So as credit and underwriting standards tighten, it becomes it becomes a little bit harder. There's a little bit of stress put on there. The September meetings were last week for the Fed. The rates did go unchanged, which is good. I think that generally the markets price a little bit ahead of where the Fed meetings are. They kind of bake in their projection of what's going to happen, which is generally why right after a Fed meeting, unless there's some huge surprise, the rates don't move that much the day after, because they're sort of already priced into to that projection. The market sentiment is mixed, but activity is picking up post summer. A lot of folks I've talked to have once that Labor Day hits and kids are back in school and vacations are over and employees are back to the grind and gearing up for the end of Q3 and beginning of Q4. There's been a lot more activity. There's been a lot more action. There's been a lot of more sort of positive sentiment in the market, and that's good for all of us. And importantly, I had a couple of folks tell me a lot more deals that are making sense to them. Right? There's deals that people try to put in front of lenders or investors that aren't realistic for underwriting standards. We'll get into that a little bit later. And so there's a lot of positive activity that's picked up just in the post Labor Day period here. And certainty of execution is paramount. I want to tell you a little bit about what that means, which is that, and that's a huge premium for companies like us. Like, we might pay more in interest rate for certainty of execution. So high level, the process for going out and getting a commercial mortgage, basically you call a bunch of lenders, right? They'll give you initial soft quotes, you negotiate them, you select a lender, you sign a term sheet with them, you wire in a deposit, and that's when the lender starts actually spending money and using more resources to confirming the facts of the due diligence that you've provided. And ultimately, all of that still has to get credit approved and go through deal committee before the lawyers can even start drawing up the loan documents, and you kind of move into a closing mode. So certainty of execution is having the right partners, the right relationships, the right people at these companies, those companies having the right track records and experience, where when you get a term sheet from them and you sign that term sheet and you're confirming everything that you've already presented to them, that they're going to close. They're going to close on the terms that they've provided for you. That is really important in this market. And that's not always something that's easy to handicap, and that comes with experience and relationships. But certainty of execution is huge, knowing that they're going to get you to the closing table, knowing that in the last couple of weeks before you close, they're not going to come up with questions or start to lose track of thought or add more questions. So that's super important in this market. Last month in Las Vegas, actually it was a few weeks ago in Las Vegas, was the big annual self-storage conference called the SSA, which is attended by lots of developers, lenders, investors, brokers, vendors, basically anybody who has anything to do with our industry. And so I had a lot of sort of rehashed conversations with folks upon leaving. And I would tell you that the feedback is sort of mixed. It's definitely bullish in the sense of on our asset class as a whole. There's a lot of things, we're not going to touch upon them in this session. There's a lot of things to be excited about in self-storage as a whole, and why there's still this it's supply constrained. It's so much excess demand around the country, and all the psychological factors that go into it, and why people in this country need storage and like it and want it. So very bullish from that standpoint. At the same time, look, some of this data doesn't lie, and there's been some flat rent growth. I think it's a little unfair to characterize this COVID pop as a reset to new normalized levels, because during that sort of 2020, 2021, there was just this outsized need, and it allowed owners to push rents up, and it created this outsized demand that you wouldn't have ordinarily had if we didn't have this work from home and displacement of COVID. So that was sort of like froth on top of a high watermark, if you will. But I certainly think it's very unfair to characterize anything in life. It's like, here's the very top, like, let's reset that as the new norm. I mean, how are you always going to eclipse that new high watermark? So we are, nationwide storage rents are still at where they were in the pre-COVID height. for our industry, and I certainly think over the next 5 to 10 years, it's going to continue to climb. So the feedback was strong overall from the conference. Let's talk about our portfolio a little bit here. Our loan portfolio is very stable. We have no near-term maturities. So one of our investors just mentioned before the call started that he heard that there's a lot of maturing debt coming due in the next couple of years, and what's going to happen? It's a great question. I think there's 5.8, I think it was 5.8 billion of CMBS debt alone. So that's just the commercial mortgage-backed security market maturing in the next 2 years. Who is going to replace those loans, right? Because if you can't replace those loans, then these borrowers move into default. Or if you don't sell a property for beyond what the loan basis is, you run into real problems. And so I think that the fact that we don't have any near-term maturities, meaning you've got a loan coming due in 3 months, what are you going to do? That gives us some nice breathing room, nice little cushion. Also, the overwhelming majority of our loans are fixed rate. I think we have one floating rate mortgage, but having fixed rate mortgages means that you're not taking index risk. You know, if the 10-year goes up or the 5-year treasury goes up, they're not passing that risk through to the borrower. Our rate is fixed and cannot change. In fact, our average interest rate is 5.46, significantly below market, to the point where I would tell you that there's not a single deal in the country going on right now that's what I would call a market deal, meaning there's not some special relationship that someone has with the CEO of a big bank type of thing. A market deal, there's nothing that's commanding better than 6%, period. Even if you're buying a cash flowing industrial multifamily property in a gateway market and you're taking only a 20% leverage loan, right? That would be considered extremely risk off for a lender. There's nothing as cheap as what we have on our books right now. It's also important to know that our loan book is with regional banks, and while those types of groups are not the most nimble, sophisticated types of capital lenders, what regional banks are not in the business of is taking back properties and owning real estate and managing real estate and making real estate profitable. That is not what they're good at. That's not their business. And so if an issue were to arise, they're more motivated than other types of lenders to work things out, to maybe put an addendum to the documents, give you forbearance, give you more time, understand the story, because they want, at the end of the day, they want to see their borrowers like us be successful. And if you ask any loan originator or any bank, the best loans that they can ever make are the ones that they get paid back on, period. That is a successful deal that they made. They give you a loan, they get their interest, they get paid back their principal, they move on to the next one. That will keep them in their seat and keep the lights on at the bank. Now we're going to talk about the 10-year treasury, because I think it's really relevant if you're watching CNBC, if you're picking up the Wall Street Journal, if you're on Twitter, wherever you get your news from, wherever you see financial headlines. You've probably you noticed that the 10-year treasury is an important benchmark rate. That's where many mortgage rates are priced off of. It's directly correlated from when the Fed has their meetings and they set their rates. They're setting the Fed funds rate, the overnight rate, the window rate, which is the rate that banks borrow from each other. But that is in lockstep with where the 10-year price is, and thus, as the 10-year treasury goes up, all mortgage rates essentially go up. So one of the big headlines that I saw this week was the 10-year treasury is at the highest level it's been since 2007, and we all know what happened that year, right? And so let's look at this chart here, right? And it is true. Here's the end of 2007. Right in the I think it topped, I guess, in the beginning of 08 at 4.8, right? And this is the volatility. It goes up, it goes down, it goes up, it goes down. It sort of bottomed out here early COVID, and now we're back up to 4.5, healthy lending rates. And so this, if you just look at this picture, you might say, wow, all right, it's expensive compared to the last 16 years. You know, there weren't some great things in the economy that went on at the end of 07, 08. Fear not, my friends. Fear not, my friends. Wait till you see this next slide. This is gonna paint a totally different picture. Okay. So, and the older you are, the more you remember this, and the more you probably have a historical perspective. So I'm gonna beat that down, right? Look at where we are today, 4.548, right? The 10-year, just double check. 4.59, all right. Look at where it was in the 70s and the 80s and the 90s. Ask anybody who had to go get a mortgage in those years what the borrowing costs look like in the mid-teens percent. So while graphs and data, you can splice things a lot of different ways to make a point for sure and to get a headline grab. If you ask me, how are mortgage rates from a historical perspective the last 40, 50 years, they're pretty good. They're pretty good. They're less than half. They're almost a third of where they used to be. And it is certainly not all gloom and doom. And there's a lot of capital out there, which is huge. They might be more conservative on how they put it out there, but having the dry powder and having the available capital and that liquidity is huge for our market, because if that's not there, then things really dry up. And then there isn't even an ability to really get leverage or to get loans. And you become complete cash investors. You know, you have to develop a project with a bunch of investors all in cash, and totally different analysis, totally different return profile. So keep in mind that the perspective here and how not always the full picture when you see a headline. We're still in a pretty good spot overall. This next slide shows you the 10-year treasury. This is the forward curve. So this is from Chatham Financial. They're one of, if not the leader in providing rate data and providing different types of hedging and derivative products. I'm not going to get into all that today. Maybe that's for our extra credit session next month, maybe. But this forward curve is the culmination essentially of data and of observable, market indicators. And they look at future contracts, they look at swap agreements and the way the big banks trade currency and trade government bonds, and they put all of that into a blender, and basically this spits out a forward curve. It's a crystal ball, and of course it's not accurate like any, it won't be perfectly accurate, but it's the best guess for sure. And so I think it's really important to show that the projection over the next, call it 9 years, right, has this upward slope, right? Okay, it's projected to go up a little bit from the mid 4s to the low 5s, 75 basis points. Let's go back a slide for a second. Even if we in 10 years from now got up to 5.5, where would we be on this historical slide? Look where we'd be. We'd still be here, right? You'd still be a third of where that peak was in the early 80s. Okay, so here's the forward curve. Not too bad of a story, but what I want you to focus on is this little window that I noticed, this little trough here, this little dip. This is sort of next summer, coming into the fall of 2025, where it's gonna dip here and be in the 4.3, 4.4% range. Why is that important to us? Get to the point, Ethan. Come on. We have a bunch of construction projects going on right now, okay, and expansion projects. When you are doing expansion and construction, you are taking a shorter term loan to implement your business plan, and in our case, build it, get your certificate of occupancy, start leasing it up, and ultimately stabilize it. Once you start to get your certificate of occupancy and leasing up, you immediately want to get out of that loan, because that's going to be a more expensive loan. And we'll get to that in a future slide where I show you a comparison. You want to get out of that loan and into a permanent loan. So we have deals that we are into for a few months, into for a year. That bracket, we are going to be coming out of a lot of our construction and transitional loans during that time period. That's going to be a great time for us to roll right into fixed rate products. And that's where that's when you want to lock into a long-term fixed rate permanent loan, and we'll be able to take advantage of that trough right there. And and the reason why that's huge is, hey, the lower our borrowing costs, the better for all of us on this call, right? When you can borrow cheaper money, that all trickles down to the bottom line for the equity and for our returns. And so when we can lock in long-term fixed rate debt at you know, at a low point, right? That's huge. We are now going to go to these might get a little granular, but don't be scared. Great. So we talked about that. Great. Okay, good. All right. So now let's just talk about, this is just, and again, this is, and Corinne mentioned this early on, like education. Like we think of our investors, no matter what level of investor you are, as our partners and our friends and our confidants. And so part of this is just going to be sharing information, and it's just because we want you to know what we know, and we want you to understand the way this works, because the capital market side can get a little dense, and some eyes can start to glaze over, but I think that when you start to understand it more and make it more tangible, that becomes a little bit more interesting and a little bit more of an exciting part of the business. So here's the way. So you've got trend. This is interest rate. You've got an index and a spread. That's basically how most loans are priced. We're going to set aside for the moment that, of course, you can have a fixed rate loan. And oftentimes that fixed rate loan is still behind the scenes priced with an index and a spread. But for right now, we're going to compare the transitional construction loans that I just mentioned when you're building a property to, once you're done building it and you get out of that loan and you get into a cheaper loan, a permanent stabilized loan. And how does that all work, right? So think of these as two big chunks, right? You got your gray chunk at the bottom, your orange chunk at the top. The gray chunk is your index. That is, for example, 10-year treasury that you see on the right, or for a transitional or construction loan, SOFR. The 1-month term SOFR is the benchmark index for transitional debt. It used to be LIBOR, which is the London Interbank Overnight Rate, that they phased out and sort of transitioned into SOFR. You may be more familiar with the LIBOR term, but essentially it's an index that none of us control, that has that forward curve, it has a projection, but none of us control what that index does. And so when you're in a floating rate loan, that index resets every month, and every month your mortgage payment changes. It can go up, it can go down, it can stay the same. Your spread does not change, right? So if we sign a construction loan with Bank ABC and it's 1-month term SOFR plus 500 basis points, 500 basis points is the same thing as saying 5%, right? 550 basis points would be the same thing as saying 5.5%. Your spread, when you close that loan, your spread does not change, period, for the life of the loan. Your spread cannot change. When you close, think of that orange box as I don't know, locked. It's like, that's like a David Copperfield lock box. You can't move it. It's locked. It doesn't move. The gray box can move and will move. It can get smaller, it can get bigger, it can stay the same. That's when you hear the term spread. The spread is really the profit that the lender is looking to make on top of their index, right? Because every lender, they're investing in a deal, they have a cost of capital too, right? Banks don't just print free money in the tree out back and pick it and then give it to you and everything they get is profit, right? They have to borrow too, right? So they have a cost of capital, and then they're transitioning that to borrowers like us at a higher cost. That's why they have a business, and that's why they have a role in this in the commercial real estate economy. Currently, spreads for transitional and construction debt, this is very general. This varies by asset class, by borrower, by location, by deal size, by time of the year. It varies by the workload and pipeline of the lender. There are so many factors that go into this, but we're just going to use some base cases here so you can see. Here's the index on the bottom. right? This is a simple addition. You're adding the spread. Here's your total all-in rate. Permanent stabilized loans, a 10-year loan would be based off of a 10-year treasury. If you were doing a 5-year loan, a lot of banks are doing 5-year loans these days. A lot of CMBS lenders are doing 5-year loans. It would simply be the 5-year treasury plus their spread. 5-year treasury today is 4.70, right? A little funky, right? That you'd be paying more for a 5-year loan than a longer term period, right? That's a little backwards. We'll get to that. Let's keep going.
Ethan,
here.
question.
Yes, sure.
Are you seeing an increase in the use of cross-collateralization in getting deals done?
Definitely. There's a lot of and that creativity started, a decade ago, but I think of cross-collateralization almost as like a credit enhancement and a creative way for lenders to get you the loan that you're looking for, right? Well, what cross-collateralization essentially means is you are like collateral. Just think of collateral. Let's just basic as a building. Cross-collateralization is when they might make a mortgage on multiple properties at once, all right? And they might take a pledge of your equity in another building. It's additional support to mitigate their risk. And so there are groups that do that on the debt side. There's also groups that do that on the equity side, where they'll say, hey, if you've got some performing assets, let's say you've got a whole book of performing assets with 3% debt on them, right? You never want to refinance that. You're not going to change a 3% mortgage for a 7% mortgage, but you've got a ton of equity in these things. You've owned them for a long time. There are groups that will actually take a pledge of that equity to cross it into a mortgage to provide you something that they wouldn't ordinarily do that's a little bit riskier. They'll take a pledge of your equity as a way to enhance their credit of you, really, as a way of, it's an additional security measure. So definitely it's out there. Certain lenders are more comfortable with that than others. I've done some of the deals in my career. They are complicated for sure. You have to get into these things called release prices. If you wanted to, let's say you had a mortgage across 5 properties, but you wanted to sell one of them. How do you handle that? You got to have a release price. You got to have a principal pay down of that loan, release that one asset, and you still have the 4 assets blanketed. It's a little complex. Could be in our future. Good question. Great question. Now I know my audience is sharp and really, really on the ball here. Great question. Yep.
Ethan, just time check. We're in our final 10 minutes.
Yep. Thank you very much. Banks versus private capital, construction loan comparison. So take a look at this, right? You can see private capital. Private capital has exploded in recent times, recent years, really. There are advantages of that and there are disadvantages. Like look at the rates. The rates are generally higher than a traditional bank. They might have an extra origination fee in there. But they're generally non-recourse, which means they can't personally have recourse against the guarantors. They're lending on the real estate. They tend to be nimble, more, in some cases, more sophisticated types of lenders. They'll look at the LTC comparison. LTC is loan to cost, right? The higher the loan to cost, the more aggressive that lender is being. Go back to my example from 2006. We buy a house with 100% financing and you don't put any down payment, right? That's 100% loan to cost. Those days are long gone. But private capital can get you more dollars, right? And that's less equity that you have to raise. And again, that's going to trickle down to your bottom line. The typical liquidity requirements for both actually is starting to even out, where they're looking for generally 10% of the loan amount in liquidity. So if we're looking for a $7 million loan, they're not just running our credit reports, right? They're looking for us to post certain net worth and liquidity requirements so that they can feel comfortable they're getting paid back. Remember, the best loans that lenders and private debt capital providers can make is the ones that they get paid back on. This is just a little bit of a comparison. Banks have, as I go back to the earlier slide, right? Banks have really clenched their underwriting standards. And so a loan that you might have been able to get from a bank before COVID or is vastly different than what you may be able to get now, but private capital that makes that more attractive. It makes that process more attractive. And in cases where we're building self-storage, we're building properties sometimes in 8 months. That is so fast for commercial real estate. From the time we put a shovel in the ground to the time it's complete, 8 months is like a blink of an eye compared to other asset classes. So in some cases, it makes sense for us to take a little bit of a higher rate. It's only for a very short period of time, but it gets us more dollars and we have no recourse. And it's much more flexible type of lender. It's a quicker process. It's a cleaner process. And we can delve into that in our extra credit session, which we'll have to schedule for later this year. Take a look at this cash flow income comparison. As rates go up, right, it's not all bad, right? Because all of a sudden you say, wow, look at if I go into a bank, if I put my money in the savings account or I buy a CD, like, okay, so they're paying me more now, as opposed to, you know, a quarter point on your money. It's like, is it really even worth spending the gas money to drive there, do all the documents just to make that, when you can have the cash sitting, you know, under your mattress? Well, now banks are paying 5 to 5.5% annually on your money. Look at how that compares to our Hearthfire Income Fund, which we have launched and have dollars raised already, lots of other future commitments. Our annual percentage rate, if you compound your interest at the highest class share, you're at 10.92%. You're at effectively double what a bank would offer. So take a look at our, when you get a chance, take a look at our income fund term sheet, read all the fine print, read all the not fine print, talk to us, ask us questions, so we can help you make your own educated decision and hopefully get some outsized yield beyond what the banks are offering you these days.